Hello and welcome. Thanks so much for joining us, and thanks, Anne, for the terrific introduction. Um, first things first, let's get our screen share going on so you guys can see what I am seeing. Otherwise, I can assure you it will be less fun if we can't see what's going on. I want to say thank you again for joining us today. Want to give a special thanks to our corporate sponsors, Bell Bank, North Star, RCU Royal Credit Union, as well as the good folks over at Supra. We're really glad to have you guys with us today for another exciting hour anyway, of data analysis. Kind of taking a look at the impact of COVID on the market, what's changed in terms of showings, sales, and other activity for May. As we mention every week, we do have a COVID resource page along with some resources for rebuilding Minneapolis after some of the recent events. So I just want to point you guys to that. Just know that there's a lot of good resources for you guys. Mar in your corner, on our website, you'll see a whole lot of really useful info. We really encourage you guys to check that out as well. I like to joke, you are here. This is where you are, Mar Weekly Webinars. So as I mentioned, we're going to talk about the market. We're going to talk showings. We're going to talk price points. We're going to talk buyer and seller activity. I want to spend some time looking at market reports for May. I know those were available last time we chatted last week, but I want to take a look at those as well as some InfoSparks number. I think we're going to skip the economic update again this week. I know I have a few slides that kind of address this. In fact, I think I got one or two early on from something I've seen. So let's keep moving. Everything still depends on these three factors: the length of this pandemic, the impact of the stimulus bills, multiple relief policy interventions, and then lastly, really the consumer response and reaction and how that's going to drive spending and behavior moving forward. So here we have the virus kind of pulling against us, and we've got our policymakers, our friends at the Fed, the Federal Reserve, and then of course our scientific community and public health experts who are doing very real and very important work, sort of pulling in the opposite direction. All right, so brace yourselves, guys. Data analysis is coming. Let's kick it off with something that I've actually never done before. Take a look at COVID-19 test results per day. There's been a lot of chatter. I know you guys have seen some of the reports in the media that cases are spiking a little bit. I know Arizona's been in the news, Florida. I know there's been some concerns in the Ozarks and after a rally in Tulsa and things like this. So I just want to take a look. This is from Calculated Risk. This is using Johns Hopkins compiles all this data. They do a great job. So I just want to show you guys. On the blue side off to the left here, we're looking at test results per day. So it's nice to see testing continuing to ramp up. And then on the right side, red, you have percent positive. So that's this red trend. So earlier on, it was about 20, 25%. Then we actually went down to 5%. And look at what we've seen lately. I don't know that I'm ready to call it a second wave, but I sure do see a little bit of an increase really over the last, week and a half, even 2 weeks. So this is worth keeping an eye on, just kind of understanding, where the pandemic is at and how we know how it's impacting housing and the economy, but just keeping an eye on this and how down the road this could have ramifications for homeowners, home buyers, home sellers, and workers as well. It affects our labor market quite a bit. So just a note on that, we are not back to these levels, but there is a little bit of a concerning increase here, so something to watch. All right, so let's just stick on this topic for 1 second. I know we've got some committed data fans on the line here, so I just want to show you guys coronavirus pandemic, 7-day moving average of new cases. So look at the EU. EU spiked, a little bit before us, so technically it usually goes to Europe first before it comes to our shores, depending on where it originates. So the EU has actually seen a really sharp decline and they've flattened out. If you look at the US in green, we were headed down for a little bit and then we have this fairly concerning trend. So again, without being an epidemiologist or immunologist or virologist, I'm hesitant to call it a second wave because I'm just not confident enough to say that, but we are seeing a little bit of a spike in new cases, and that is a little bit concerning. Again, EU low and falling, US by comparison, sort of high and rising. So some interesting differences there. And don't forget, US population got about 330 million people here versus almost 450 million people in the entire Eurozone. So know that this is not a percentage basis. This is the number of new cases. So they're bigger than us, and they still have way fewer, what, about a fifth, 80% fewer new cases. So interesting data there. All right, let's keep on this topic of looking at some new stuff before we dive into some of the updates on our normal charts and visuals. So this is this shows us the percentage of active listings priced under $250,000 using our rolling 12-month average, right? So I've titled this the affordability squeeze. Just looking at St. Paul in red, Minneapolis in blue, and the whole Twin Cities metro in gray. So St. Paul, Minneapolis, and then the whole Twin Cities. So what this is saying is at one point, well, let's just do the whole metro. At one point, about 70% of homes that are under active status were priced under $250,000. Well, that was almost 10 years ago. We know the market's changed. Now, 70% has become about 21 or 22%. This is an unbelievable change and really speaks to what's happened in terms of affordability. Even if we look at the peak of the bubble, right, maybe middle of 06, when you saw all three geographies, St. Paul in red, Minneapolis in blue, and whole Twin Cities metro in gray, at the peak of the bubble, you saw this pretty low. Why? Because prices were pretty high. So it makes sense that the percentage of listings under 250K were low at this time. Well, look at where we've gone since then, right? So even in the bubble, right, the Twin Cities still had over 50% of its active listings were under that 250K mark. Now it's more like 20%. So it used to be 5 out of 10. It's now about 2 out of 10. So quite a difference there. Just wanted to show that to you guys. I updated this through May. Okay, one other new one, interesting one for you guys. This is the JOLTS report. I know that's a really exciting title. It's a job openings and labor turnover survey. Pretty exciting stuff, if you ask me. So just taking a look at this, guys, I think one of the most interesting, well, let's start with layoffs and discharges, right? Let's dispense with the Tyrannosaurus Rex in the room. So you can really see exactly how layoffs and discharges and those changes in our labor force, you can really visualize that after COVID. And look at 08, 09, right? I mean, we have completely dwarfed that trend by comparison. Now, I think this will come down a little bit more quickly than this has. Can't guarantee that, but seems to be the case. This was, sort of finance and mortgage and economic driven. This is health driven. And so I think once the health situation gets a little bit more under control, we'll see some improvements here. Here's the other really interesting insight that I've picked up from this. Look at job openings in blue. Notice how job openings have actually been on the decline pretty much throughout 2019, guys. And yes, that's continued into 2020, obviously, for pretty obvious reasons. But actually, it looked like job openings, it looks like the economy could have been slowing a little bit in 2019. So some folks that see this as a kind of a pie in the sky and a shoe that fell out of nowhere, they're right, but we did see some slowdowns in the economy, particularly by way of job openings well before COVID. So I just thought that was a pretty interesting thing to point out. All right, let us go into the market. So guys, by far, inventory is the biggest factor holding back sales. You guys are going to see some remarkably encouraging figures when it comes to the demand side, but we're still kind of struggling a little bit. We're still a little bit challenged on the supply side, where sellers still don't seem to have the same degree of confidence as buyers have, which to some extent is understandable, but we really need to see more movement on that supply side of the equation. This is a really, I alluded this is a really new and interesting development. You guys, I don't know if you'll even believe this. I'll show you though. contract activity last week, so pending sales last week, were higher than in the past 3 years at this time. So buyer activity last week was ahead of 2017, 18, and 2019 levels. Again, which is pretty remarkable for mid-March to mid-April to mid-May to mid-June. Pretty remarkable for 3 months after the start of a pandemic. So we'll dive into that more. Here's another really interesting one that I've pulled out from InfoSparks, which I plan to spend some time in, by the way. So don't leave. Look at the median percent of original list price received at the time of sale. So when this is 100%, right, for condos, back in our condo bubble in 05, 06, condo sellers were yielding or realizing 100% of their original list price. As things deteriorated, right, coming into 2011, 2012, actually condo sellers, I don't have the exact figure, looks like about 89, if this is 88, call it about 99%, maybe 89.8 or 89.9, so about 90%. In other words, condo sellers had to offer a 10% discount or a 10% coupon just to get some of these listings sold in this time frame. Since then, you guys can see single family and townhome have really rallied all the way back up to 100%, I should say. So that's pretty encouraging. Check out condos though. Some say, condos catch, when the market catches a cold or is about to catch a cold, condos catch pneumonia. I know that applies to some other dynamics in our community as well. So look at condos, guys. Look at how this metric, this indicator, actually began declining in 2019. In other words, the condo market was actually softening just a little bit starting around the middle of last year. I think this first decline here was August. So condo market has been softening for about a year. It's tempting to look at this figure and say, oh my gosh, look at what COVID did to the condo market. And in some ways that's accurate. In other ways, this trend had already begun. So just something to think about, something to consider when we're talking with buyers and sellers, listing presentations, open houses. Just understand there have been some changes on that condo side. A good way to think about that from an application standpoint, from a practical standpoint, if condo sellers are expecting to get 100 or 105 or 110%, this kind of shows that they're a little bit less likely to get that, compared to here, surely compared to here, but they're in much better shape. Well, I don't even need to just do this. They're in much better shape than they have been, for this whole period. So just understand that. All right, I spent a lot of time on that, but I thought it was a pretty interesting trend. Alrighty, back to our showings numbers. This is from Showing Time, right from the North Star system. Daily showing activity. So we've got this year in blue. We've got last year, 2019, in gray. I just like pointing out because I just find it interesting. Pardon my phone. I find it interesting. What is that? Memorial Day. So it looks like Mother's Day, Memorial Day, 4th of July, Labor Day, Thanksgiving dip, and then the Christmas, Hanukkah, whatever else is going on, end of the year little dip. So, we have these dips, and what's so interesting is this year's trend in blue has really synced up nicely with the previous year's trend. So in other words, 2020 showing activity is got pretty well matched up with 2019 numbers until we sort of surged ahead a little bit. And I think this is really fascinating. Some folks thought that the blue trend line for this year, right, once it got to this point, some folks kind of thought we'd be kind of mirroring that trend, but that really hasn't happened. We've actually gotten to new highs for the year, not just for this year. If you guys will notice, we exceeded 5,500 based on our rolling weekly average. 2019 never exceeded 5,500, in terms of showing. So yes, showing activity in 2020 has reached a new all-time high for 2020, but it's also exceeded showing levels at any point in 2019. Pretty encouraging data point. Not to get too geeky with some of this stuff, but let me just say, when you think about the delta, the area under this curve, right, the area between last year's trend and this year's trend, The question is, well, we're already making up some of that. The question is, how much of this can we make up here? If we stay above 2019 for some time, it's possible that we can make up much of this. I don't know about all of it. If we see this trend kind of start to do this and mirror last year's trend, then we probably won't make up all of it. The reason we think about that kind of thing is because if showings can kind of follow that trend and make up some of that, typically pendings or contracts will follow, and then closings will follow. So, this is a great leading indicator for demand, as we've been saying for months now. Well, years, maybe even a decade. Anyway, all right. So I know you guys have seen this. Most of you have anyway. It still applies. So I just want to cover it for anyone new on the call here, or any watching later on at home or on the go, I suppose. So think of affordable, luxury, and mid-market, right? You've got a lot of young buyers who are interested in affordable. A lot of them are working leisure, hospitality, restaurant, or retail jobs. Those folks can't work from home, so they're going to be probably more reluctant to buy. Luxury, there's a wealth effect, right? It's this perception. The higher my stock portfolio goes, the wealthier I feel, the more willing I am to open up my wallet and spend. Our economy is 66% dependent on consumer discretionary spending. So looking at the health of the consumer and of retail spending's been pretty weak for obvious reasons, minus Amazon and grocery stores, right? No one's going out to eat, at least almost no one, and everyone's shopping and realizing maybe my cooking skills aren't too bad. So when you have the stock market down, and it's actually almost back to where it was. I know we had a down day, I think yesterday. So just be thinking about that with luxury buyers. If you guys are working with people in the 750,000, million, 1.5 million range, no, we're not Los Angeles. We don't have $200 million homes. I thought I saw that on some TV show. But we do have, I think, what was our record? Maybe a $10 or $11 million sale over on, is it Brackett's Point or somewhere over in Orono, Wayzata? Anyway, so just keep an eye on that side of the market as well. And then middle market, just our kind of, I don't want to say boring, but our boring, steady Eddie, salaried professionals who are able to work from home. Maybe they've got kid number 1 or kid number 2 on the way. And maybe they're looking at forming or forging a new household. So the mid-market seems to be performing the best. Just like we said, guys, April job losses, look at leisure and hospitality, by far the most dramatic declines. We always like to acknowledge, people ask, how in the world could health jobs be down? It's all about elective procedures. Hospitals have really, and healthcare centers have really cut down on any sort of elective procedures, because it's pretty important to keep those beds open for COVID and other sort of necessary procedures. We showed this last time, so this is only the second time we're looking at this. Percent of respondents saying that this has happened to them or someone in their household because of COVID. So 28% of all adults been laid off or lost a job. Remember, not just them, but someone in their household. 1 in 3 had to take a cut in pay. Looking at, just thinking about the tensions in our country right now, especially in our city and region, I think it's important to look at some of these breakdowns by demographic groups in terms of age, race, educational attainment, and socioeconomic status. So, we can see that there's a disproportional effect from our Caucasian to our Black to our Hispanic communities. So we can see our Hispanic community, 41% have been late. 41% had someone in their household either laid off or lost a job, and 51% had to take a pay cut versus 29% in our Caucasian community and 34% in our Black community. Age, younger folks taking a harder hit, guys. They're working these jobs, a lot of them, not all of them, but many. So 35%, 45%, so definitely higher figures there. And as you get older, obviously, lower likelihood. There's also a lower likelihood that folks over 65 are in the labor force at all. So just know that. And then bachelor's versus high school. We know folks with a high school degree or less have been harder hit. We also know lower income folks have been harder hit than higher earners. And just know there's a lot of intersection, or I think what the literature now is calling intersectionality between some of these different variables or breakouts. All right. Millennials, yay, living through their second once-in-a-generation economic collapse, giving each other elbow bumps. Wonderful. So this all gives us a theory, you guys. If we see some weakness on the affordable end, and perhaps we see some weakness on the luxury end, might that mean that our middle market is the best performer? Okay, so after some survey results, I read your survey results. I'm not going to cover old information like we have been going over some of the past info. I do want to show, this is pretty much my only one where I show a March number. So look at this, guys. Change in showing activity, that last week of March. Everything down. Every price point had a decline in showing activity. Luxury markets, more of a decline than the affordable segments. So that was the last week of March. Moving into sort of mid-April, some up, some down, some up, some down, some up, some down. Kind of a transitional week. Fast forwarding into that second to last week of April, so the week ended April 19th, wow, here we see really strong growth in showings. And then fast forward a little bit to mid-May, now we see a little bit more normal growth, right? 13, 20, 13% versus 50, 60, and 90%. So a little bit more normal here. So everything down, then a mixed bag, everything up, and now we're kind of settling into a pattern. I have to show this to you guys. I love this. I think this is really, well, I got to stop being modest. I'm really proud of how this work and this analysis and this data has really been able to help us visualize and track what's going on. So we were able to see declines across the board, then a mixed bag, then a nice recovery across the board, and now we're kind of settling into a pattern. So I think this is just unbelievably cool in terms of how we're able to capture that change and communicate it to you guys and to the media and to your clients. Well, to help you guys communicate it to your clients. So a quick anecdote. I know we've talked about this. We are still hearing from builders and agents that showing traffic is down, but it's a higher quality traffic. It seems to be a more motivated buyer. So that's pretty, I think that's a pretty interesting anecdote there. And they're saying that the true qualified buyers are still there, but these fringe buyers have sort of dropped off and moved on a little bit. All right, let's keep trucking. So this is our most recent, these are our most recent figures for that week ending June 21. So what does that go through Sunday or so? Showing activity by price point. Again, we can see our big gainer. And again, guys, this is week to week. So, you know, we don't usually do week to week, but because of all the changes and everything happening in the market and in the economy and in our metro and our world, you know, I think it is important to kind of track week to week, you know, especially in March and April and May, when we saw these declines week to week versus the gains. It really gave us, you know, a nice signal that things were turning around. And sometimes it's even better than comparing year over year. So our big gainer this week, or I suppose last week compared to the prior week, our big gainer was $250,000 up to 300,000. That's where we saw, I think not the only increase, but definitely our largest increase. Looks like we did see some gains elsewhere, but we also saw some declines in some of our most affordable segments. So the winner seems to be this 250 to 300K range, which makes sense because our median sold price in the metro is just about you know, 290, 295. So makes sense there. All right, looking at the share of overall showing activity. So this one showed the number of showings, right? Look, 6, 7, 8,000. This one shows the percentage. So if we had 100 showings, 22 of them would have occurred in this range, right? So this is obviously percentages. So this looks at sort of the share or the market share of overall showing activity by price range. So you guys can see, just looking at $1 million plus, 1.6% of our showings happened on listings over $1 million. 10%, so 1 in 10 out of 100 showings were on homes in that 400 to 500,000 range. So, you know, 4.25 is a pretty popular price point, especially with new construction, which does seem to be doing a little bit better. And we'll take a look at that once we pivot into InfoSparks. Okay, guys. Well, let's just spend one more second here. So call this 21 plus 19 is 40 plus 22 is about 62%. So almost 2/3 of our showings, right, happen on homes priced under 300,000. So obviously the bulk of our market is here, but we do see some growth that I think is notable in some of our other segments. Taking a look now at the change in showing activity, no surprise here, guys. There's our 250 to 300 range with a nice 9% bump in showing activity. Also saw a nice 7.5% gain in that, I always struggle with the terminology, maybe that young luxury market or that early, or what do we call it? Entry level luxury. Maybe that's what I should say, entry level luxury. Maybe we can argue that starts at 600. Maybe this is the second move up level of luxury, and maybe this is the true luxury. I don't know, just funny ways to think about some of that stuff. So overall, showing activity only down about 0.5% from week to week. And remember, typically we see a lot of showing activity at the beginning of the month when some of those new listings come on. It's such a competitive market out there, as you guys all know, that folks tend to, want to get out and take a look at some of the stuff right away. So I know we've talked about this in the past as well. Just a quick reminder, I just think this is really helpful to think about, at least for me, I think for you guys as well. Life cycle of a listing. So first a listing is new, then it's active. First a buyer gets a pre-approval letter, then they go to showings, then they write offers and have a pending sale. And then hopefully, and what is it, 95% of the time, that goes to the closing table as well. So what's going to happen with active listings? Well, why don't you take a look at new, because that's earlier in the life cycle of a listing. Now, again, some of these new listings are going to be snapped up really early on by really hungry, really thirsty buyers. But just a reminder that there is a process, there is a cycle to this. And so one of our goals, you want to predict closings, look at pendings. You want to predict pendings, look at showings. You want to predict showings, look at pre-approval letters, mortgage applications. I know the MBA, the Mortgage Bankers Association, not a master's in business administration. Our friends at the Mortgage Bankers Association do a really good job of showing mortgage applications and all that stuff. So just a way of thinking of, how can we get ahead of this? This helps me think through that. We're going to skip this for now. We're going to go into our weekly market activity report in just a second. I want to show you guys some of our other detailed charts on buyer and seller activity. So as you guys know, this is by far one of my favorites. Taking a look at daily new listing counts. So basically seller activity by day, but instead of it being so volatile and noisy, I like to say, and by the way, this is a fairly noisy data set. Instead of daily, I've actually rolled up those daily counts into a moving weekly average. So any one point reflects the previous 7 days, and it just kind of rolls through time that way. So, I like to point out, let's see, where was it? So right in mid-March, right before our whole world changed there, take a look, guys, new listings actually higher than they had been in the previous 3 years. So highest of the last 4 years, 2020, sellers were looking pretty good until COVID happened and they weren't looking so good. So, it's nice to see, well, let's kind of do the whole math here. So mid-March, maybe end of March, we saw the decline. Mid-April, we kind of saw that bottom and some recovery. And then we have been mimicking this trend from prior years. So, this is really interesting, guys. Imagine if I didn't have these 3 years. I didn't have 17, 18, and 19. I think you guys would be looking at this dip and say, well, what happened? And actually, if you look at the timing, it looks like a Memorial Day dip at the end of May. So maybe some people would have attributed that to some of the unrest or events that surrounded Memorial Day. But really, this is a trend that happens every year. So just be aware of that. What's a little bit more challenging, especially for buyers and for our supply picture overall, what's challenging is that we still have a delta here. There's still a pretty significant gap. So while sellers were looking pretty strong, new listing activity was looking pretty strong earlier this year. And even if you go back sooner, you guys, okay, so there's that Super Bowl. There's where things kind of kicked off. Get it? Super Bowl kicked off. Not bad, not bad. So we can see that increase in seller activity. And notice 2020 in black, right? It was the second highest. It's been almost the highest, second highest. It was the highest. So, so far this year, sellers were actually, it seemed like they were feeling fairly confident until everything changed. So still a gap here. The question is, can we maintain this uptrend? Can we keep this floor, this bottom intact and not go back below it? I think so. I hope so. That is not a forecast. That is not the official position of the association. It's just so hard to tell, you guys. So it's our hope we can keep this uptrend. Now, this is the most exciting part. This is new listings. Let's take a look at pendings. Already, you guys, take a look at this. It's amazing. It's really unbelievable just how much buyers have come back. So we're going to actually take a look at this in even more depth. I want to also show you, let's go a little bit back into history. We can see pending sales, so signed contracts, right? Accepted offers, also performing really nicely at the beginning of this year. Come mid-March, right? Here we go, mid-March. Almost like clockwork, March 15th. Well, clockwork, that's when the stay-at-home order and the school closure happened. So maybe not like clockwork, but like executive orders go, so goes the market. Then we saw these declines. So mid-March, hitting a bottom just about mid-April. So just about exactly a month of declines on the buyer side. And then look what's happened since, right? This is really remarkable. I'll say it again. So I'm going to zoom in for you guys. I'm going to really zoom in. Take a look. Pending sales, 2020. Highest of the last 4 years. It looks like we're kind of matched up with last year again. But I think this is just remarkable. And this is what I was saying at the beginning, you guys. Pending sales in 2020 are higher than they've been in the last 4 years. I should say for the year so far. So for the year-to-date period, 2020 signed contracts are at levels, at the highest level of the last 4 years. I think that is a remarkably encouraging data point. And frankly, I think a lot of folks are going to be surprised by that. So we've talked about new listings. We've talked about pending sales or under contracts. Now, how about we use a ratio to compare the two? So, it's nice to look at each individually, but, this doesn't happen in a vacuum. It's nice to look at this ratio. So the pending sales to new listings ratio, the way to interpret this, if the value is 90%, like it is here, well, if the value is 95%, that tells us there were 95 pending sales for every 100 new listings. And yes, you are reading this right. We have never been this high. For this year so far, of the last 4 years, we have never been this high for this time. Look at 17, 18, and 19, trending at about 75%. So there were about 75 pending sales for every 100 new listings. Most recently, we're seeing about 96 pending sales for every 100 new listings. Again, a pretty remarkable data point. And just know that this is telling us that pending sales are really outpacing new listings. They're not more on a raw number basis, but they really are, I don't know that I want to say overwhelmed. Well, maybe that's right. Buyer activity is really overwhelming seller activity. And so, buyers have come all the way back, we just saw, but sellers have not come all the way back. That drives this ratio higher because the numerator goes higher and the denominator kind of stays the same. So 3/2, and then 4/2, and then 5/2, right? It kind of keeps growing that way. So really a remarkable data point that really proves just how tight this market is this year, at this time this year, I should say. Notice mid-March, this was not the case. We had about 65 pending sales for every new listing. But yeah, again, pretty remarkable. I know I've said that 3 times. I mean it. All right, let's keep trucking. So looking at some year-over-year comparisons, so this is change in new listings, so change in seller activity by price point. This is roughly the same week last year compared to the same week this year. So this is the week ended June 20th of 2020 versus the week ending June 22nd of 2019. Don't worry too much about those 2 days. Just know that both weeks included, well, by definition, they included 5 work days and 2 weekend days. So not to worry there. All right, so taking a look at this, just diving in, we see some pretty notable declines in seller activity on the affordable end, right? Makes sense. As these homes or properties are getting bought up, very few are being relisted. I'll tell you something. If I owned a $180,000 single family home in a nice area, I don't think I'd sell it. I would hang on to it. So, understandable. Also, builders are just not able to hit these price points, even though there's a lot of demand here. So it's pretty predictable that we'd see declines here. We also saw a fairly sharp decline, down 30% on the 1 million plus side. Where did we see, sorry guys, where did we see our best performer? Or what's the language we use? The best of a bad bunch, minus just 9% for 350 to 500K. So middle market still performing the best or the least bad. I guess technically, we had a 0% change or a flat movement in 750,000 up to $1 million. Same time period, same week last year compared to the most recent week this year. Now on the pending sales side. So again, notable declines. There just isn't any supply to purchase here. And actually, what's pretty interesting, check this out. Even though on the seller side, our three most affordable brackets were down, let's see, 46, 35, and 50. Let's call it 45, 35, and 50. 45, 35, and 50. Notice buyer activity was not down nearly as much. That tells us that there's more demand. Well, obviously, here's things that are obvious for 800, Alex. Thanks a lot. Obviously, there's more demand in these markets than there is supply. Obviously. All right, biggest gainer, 750,000 up to $1 million. We saw 36% rally there on the pending sales side, on the demand side. Again, seeing a nice gain, not the biggest gain, but a nice 9% gain in contract signing for 250K up to 350K. Million plus on the offer side, down about 4.25%. Overall, we were up about 1% from last year on pending. So again, not a surprise. We're seeing gains. We saw that we've reached the highest level for this time in any of the past 4 years. I know that's complicated, but we have to get it right. Okay, so year over year monthly change, we just looked at weekly change. How about year over year change by month? I know, I'm showing you guys March numbers. It'll just take 20 seconds. So just take a peek at this as a reminder. Biggest losses in new listings, biggest loss in affordable. We also saw a loss in luxury or entry-level luxury. Did see a gain in our true luxury segment over $1 million. But look, you guys, look where the bulk of our activity is. Look at where we had these gainers in March, right? Mid-market ranges, no surprise. Pending sales, declines in affordable, declines in luxury. For the most part, gains in middle market. That was March. Okay, viewer discretion is advised. Now we're going to look at April before we take a peek at May. So April, again, on the new listing side, you guys, this is seller activity. We can see, 40%, maybe 38 to 45% declines in affordable, 43% decline in million plus. And again, the best of a bad bunch was sort of that middle market, 350 up to 500K range, only a 7% decline in seller activity. So again, we have this little bit of this curve here, a little bit of a normal curve, just like we saw in March on both sides, by the way. So even though everything is below zero, we still see a little bit of this normal curve where these mid-market ranges are down a lot less than some of our other ranges. All right. So again, mid-market ranges. Let's take a look at pending sales for April. Pretty similar story, guys. Maybe minus the 750 up to $1 million with no change. Pretty interesting. Down 16, 17% for $1 million plus. But here again, down only about 12 to 13% for our mid-market ranges. I'll just say again, guys, salaried professionals who are able to work from home, who aren't suffering through job losses or any losses to household income, those guys, that segment of our buyer pool seems to be the most stable, I guess I should say. Mid-market, can't make this stuff up. All right, here we go with May, my friends. Affordable. New listings, we saw the biggest declines in affordable, no surprise there. So down about 40 to 43%. Overall, down about 22.5% for May. I guess our winner here is Million Plus, where sellers only listed 8.3% fewer new listings this May than they did last May. So that's kind of how we think about this. Another decent performer, half a mil up to 3/4 of a mil, kind of interesting there. Again, I guess not the best performance, but you know, somewhere in the middle, not a terrible performance from our mid-market ranges once again. Change in sales by price point for May. This one's a little bit more maybe encouraging, or maybe a little bit, it confirms some of our theory with the mid-market a little bit more. Pretty steep declines in affordable, fairly steep declines in luxury, and hey, look, homes between 350 and 500, pending sales only down, you know, 1.5% to 2%. Not a major decline here. Guys, there's a lot of nice homes for 375, you know, to 4.25. You know, I know that 495 is starting to get into, you know, it's hard to call that affordable. It's starting to get into the move up, and you know, a little bit different than what I would think of as entry level, or that first move up. So just to think about here, not a bad performance here, even though it was down, you know, overall down 13% versus just 2 and 2.5. So something to keep an eye on there. All right, we have reached the time, my friends, where I like to pivot into InfoSparks and some of our market reports. So if you would allow me, let me just get switched up here. Okay, so here we are, our homepage, mplsrealtor.com. Hopefully that is familiar to you guys. COVID resource page I was mentioning, as well as our rebuilding community resources there. Most of you are well aware, but some of you who are watching the recording may not be. All of our many wonderful market reports live here. So just from our homepage, mplsrealtor.com, you can either click on market data and find our reports that way. I tend to just scroll down and find what I'm looking for down here. I'm going to click on local market updates. You guys are going to see it takes us to this fast stats interface. You know, our major report that the media kind of reports on is this monthly indicator. So I'll just give this a really quick click. You guys can see this is for May. You can also see, let me blow this up a little bit. You can see what happened with seller activity for the month as well as for the year so far. So although seller activity was down 24% in May, it's only down about 5.5% for the year as a whole, for the year to date so far, I should say. Pending's down about 14%, but only 3% on the year. And you guys can kind of see how things look from there. Median sales price still up 3.5%. That is the smallest gain that we've seen in a couple years, but it was still a gain. Some folks were surprised by that. And there we are, kind of hanging out at 295 for that median price for the whole metro. Okay, so let's keep going. I want to show you guys some of our other reports. So I'll hop into our local. Well, you know what? Sorry, before I do that, I promised we'd take a look at the weekly report. So let's just take a quick look at the weekly. You know, and you guys are going to see pretty much the same trends I showed you in our kind of multiple year trend. So here we go, right? We see that dip with new listings in 2020. We saw a very similar dip last year in our 2019 numbers for new listings. Oops, sorry guys, I'm a little cut off. We can also see that we're a little bit, there's a little bit of a gap here between this year and prior years. So that's new listings. How about over to pendings? So remember, this only goes through 6/13. This is why we show you guys the other numbers that go through, what was it? That go through the 21st, that would be. Yeah, so the numbers that go through the 21st or 22nd even, I think I updated it. And this is only through the 13th. So we've got another week in numbers. And as we can see, I expect next week we will show that blue is either really close to or possibly even above 2019. Remember though, this is just a plain weekly snapshot versus a rolling weekly average. So just know there's a different methodology here. One of my favorite words, there's a methodological difference. I like that, a methodological difference. A little bit of trivia there. Okay, so pending sales, let's go back. Let's check out our local market updates really quickly. beautiful map that should be familiar to you guys. If not, stay after class and we have to have a quick chat. So Hennepin County, I'll give Hennepin a click. We can now see all the many varied and wonderful cities within Minnesota's largest county. Three things are going to look different to you guys. Lake Minnetonka, because it's got a lot of unique local areas. I see Dennis is with us. Dennis really cares a lot about Orono and lives in Orono. So Minneapolis is also unique, right? We've got our Northeast community, near North, Central. Within the Central community, then we've got the North Loop neighborhood, Loring Park neighborhood, right? Within the Southwest community, we've got Linden Hills, Fulton, Kingfield, Armitage, Kenny, and Windham, right? And then within the Longfellow community, there we see Seward, Longfellow, Howe, and Hiawatha. If you want to look at the whole Minneapolis report, you can do that. But just know, a price of $294, there's going to be some listings in Linden Hills that are going to be over $1 million, and there's going to be listings elsewhere that could be 80,000 or 125,000 or so. So what I like about the next page here is that it actually breaks things down by community, right? So we can look at Longfellow versus Southwest. So it looks like Southwest, wow, University, 71% gain. There must have been some condo or some project that opened. There's been an unbelievable amount of construction over there. I don't even recognize Washington Avenue anymore when I drive it. As we talked about, here's Southwest at about 380 versus a more affordable area, maybe Camden at about 200 or Phillips at 212. Where are my friends in Powderhorn? Powderhorn at maybe 260, 265. Okay, so I just want you guys to know that. And we've got Bloomington as well, East and West. No, it is not Jefferson versus Kennedy. Everyone always thinks that. It is just 35W is the divider between East and West. We can check out Maple Grove as well. In addition to our inner cities, we've got all of our suburbs. Maple Grove, about 3.25. Let's just hop into one more versus Plymouth. More like 375. And you guys can see, how sellers did, how buyers did for the month of May versus for the previous 12 months. Use this, you guys. Seriously, use it. Do a screenshot of it. Throw it in a mailer. Put it in social media. Use this link. Email it, text it, tweet it, Facebook it to your clients, to folks in your pipeline. Or I think, as you guys say, to folks in your sphere. I like that word, my sphere. All right, so I think that pretty much covers all of our PDF reports, or static reports. In our final 5 or 10 minutes, I really want to go into InfoSparks. Let me just do a quick check on chat. Oh, Dennis. Dennis is funny. Okay, so North Star, guys. From the North Star Matrix page, you guys will see under Home, you'll see InfoSparks. You'll also see InfoSparks listed here under External Links. You can also find it from a listing page. What should we do? Hey, let's do Brainerd today. That's kind of exciting. I like Brainerd. All right, 232. Not too bad. Nice lawn. Actually, surprisingly nice. Anyway, okay. So sorry, I get distracted, you guys. So you'll see this InfoSparks link right here as well. And because we're in Brainerd, note where it takes us. It's alive, right? It's smart. We baked intelligence into it. So it knows to take us to Brainerd. Versus if I just access it from here, it'll just take us to the Twin Cities region. So I've already got that queued up. I've got Twin Cities region. Oops, sorry. Let me get out of my construction type. So let me just refresh this, just so you guys know, this is where you are when you land on InfoSparks. So everything you're looking at now is exactly what you'll see when you first log into the tool from Matrix. Median sales price, $285. That's not for May, that's for the previous 12 months. If we just want to look at May, we got to do the monthly, and there's our roughly $295 versus the rolling 12 months, which is a little more like $285. Makes sense, you guys. May prices in May and June are always higher than December, January, and February. So it makes sense that the last 12 months are obviously lower than just the month of May. I've got the month of May. There's a song about that. All right, so 3 years. One of the things I do is I love to look at history, right? I just like to see the long-term trend. So you guys can kind of see some of the bubble in '06, the downturn into 2012, and then the pretty robust recovery ever since, right? It's pretty clear to see. 230, we are well above those bubble highs, and we're at about 285. So, well, let's just talk about the 4 prongs. I like to go through these just if anyone is not familiar with the tool or anyone watching at home. The first thing I do as I think about it is prong 1, pick your area. We can filter down to counties, neighborhoods, communities, cities. Just know that you're going to show a whole lot of really small townships, but if they're in the data, they're in the data, you guys. I know there's a lot here. There's a whole lot of these little townships with maybe one listing or one sale in the last 10 years. But if they're in the data, they have to be in this list. So there's going to be a lot of things that you may not be super familiar with. So just a word of caution. School district, a really popular option for, I don't care if you're a first-time buyer, if you're a family with kids, or if you're a boomer or a millennial, it doesn't matter. People care about school district a lot in terms of resale. Zip code, as I start typing 5543, you guys can start to see all of our different zip codes. My areas, we'll talk about that if we have time. Next, after areas, I do metrics. So what do I want to look at? So far, we're looking at home prices. Maybe I want to look at absorption rates and find that I have 2.2 months of supply in the metro. Definitely a seller's market. Maybe I want to look at days on market. Pretty interesting, right? Homes used to take 105, even 116 days to sell, 117 even. 12 years later, we're about 3 weeks on the market, 22 days. But understand that that's for, a home price near the median, 285. It's different based on different price points. So I'll just show you guys, new listings. I'll just show us the trend really quickly. No, we are not really anywhere near where we were back in '06, '07. And, in some ways that's good, but we still need more supply than we have. Take a look at this, guys. January, Feb, March, I see a nice upswing. We were actually on a nice upswing until COVID. And then we can see the impact on April and May numbers. This is 12-month. We can look at the monthly, and you can really see, looks like we peak for new listings. We peak in May, and you guys can see May, and we are well below where we were. It's possible June has an increase. I would say that's not common. I suppose it happened here in 2016. It was not a large increase. What it looks like 13, an increase of 13 additional new listings. So there is some hope, but it's possible that we've maxed out in terms of seller activity for the year. Now, listen, guys, in October, we still have 6,000 new listings. So sellers don't go away in May. What is that? Didn't a stockbroker used to say that? Sell in May and go away. So just know there's plenty of activity, but it typically maxes out in May. All right, so something else I really want to take a look at, guys. Percent of original list price. And if we look at this monthly, and you know what? I know this is going to sound crazy. I'm actually going to go back to our monthly report. I really want to show you guys something. This indicator, this percent of original list price received at sale, I think people don't love it because it doesn't take into account seller pays or any seller concessions. Not every listing has those. A lot of them do, but it's really hard to take that into account in our data. So all we do is just simply a ratio of sold price to original list price. So if you were listed at 300,000 and you sold for 270,000, you got 90% of your original list price. So take a look at this, guys. This metric in particular really does a phenomenal job of kind of forecasting maybe or serving as a leading indicator of what's happening. So take a look. Ever since September of last year, when rates kind of became pretty friendly, that ratio of sold to list price was rising. I guess it was flat here, rising. Suddenly, May, we have a decline. Right from 100% last May down to 99.6% this May. Now, guys, let's keep this in context. Sorry, let's keep this in context. 100%, 99.6. It is a remarkably strong figure, but it is not as high as last May. And it's surely not as high as, remember, since this is June 2019, this is actually June 2018, where it was over 100%. And we can actually see that right here, right? June 2018, over this 100% line. So pretty interesting data point there. So, even though we can't see all that, we don't have the benefit of that data table in this view, just understand that, well, that's a great example of how to combine some of our PDF reports from FastStats with some of our interactive reporting from InfoSparks. So, I think because we've been playing with price ranges, let me just do this really quickly. And you know what? You guys have been giving me feedback that I move too fast, and I apologize for that. So let me slow down. Price ranges. Instead of clicking breakout or filtering down, what I'm going to do is click custom. It's actually a button. I can either clear them out or just leave them. I'm going to do 240, 0 to 250. Let's do 250 up to 499, 500 up to 999, and then a million plus. I know that was fast, but you guys can enter whatever figures you want here. So now we've got our custom ranges here. Now I do want to break them out. And this will just take our server a second to think. All right, so kind of noisy data with million plus. So let me use our rolling 12 month just to kind of smooth things out a little more. I like to say that the macro picture will sort of give us more takeaways. It helps us visualize kind of more meaningful visuals, I guess. There you go. Okay, so here you have our two most affordable ranges, under 250 and 250 to 500. Still at 100%, guys. Still pretty strong in terms of offers. Even $500,000 up to $1 million, still pretty strong. $1 million plus, we do see some decline. So I do see some weakness in $1 million plus. As you guys can see, $1 million plus used to get about 96%. Now they're at about 95.25%. That is such a far cry from 85.5%. You guys, $1 million home at 85% of original, they can expect to receive $850,000, right? They can expect to take a $150,000 off in terms of the offers that they got back in fourth quarter 2011. So some important changes here. There's other ways to visualize this, just so you guys know. You can do bar charts as well. I want to get out of this, and let me just do a quick property type breakout. And I'm just going to use our single family, condo, and townhome. Here again, we can show a little bit of weakness in condos, down 0.5%, 99.5 down to 99. Townhome and single family still looking pretty strong. All right, I know we're close to time, you guys. Let me just do one last one. I want to look at new construction. We have some friends at Housing First and formerly the Builders Association of the Twin Cities, and they do great work. And we partner with them on a lot of things, and they rely on us for some of our data to communicate out to their members. So take a look at this, guys. Seller activity for new construction, almost perfectly flat, 935 to 934. Builders listed one fewer new home listing this May than they did last May. So down 0.1%. I call that 0% change. That is flat. And it's actually pretty remarkable. How about on the existing side? Down about 25%. How about pending sales? Look at new construction. Down just 0.5%. Existing or resale down about 14%. Let's see. Let's just take a look at absorption rates. We're going to show new construction fairly balanced with 5.2 months. That is right between our 5 and 6 month of supply mark. That's a balanced market. Our sort of tragically undersupplied market is, of course, where most of our affordable product is and where most of our closer in product is. Think first ring suburbs and core cities. And that's all in our previously owned or existing segment. Makes sense, you guys. Existing homes cost about $285 on a median metro wide, while new homes metro wide are going to cost you more like $415,000 to $420,000. So key difference here, and no wonder when you look at the volume, no wonder we see growth in most of the activity where we see the affordable product. With that, we're at 3:01. I'm so sorry for going a minute over. Let's pause and just see if there are any questions.
Yeah, I haven't seen any come in yet, David, but we can give them a minute in case somebody's got something they want to send.
Yeah, if anyone has any thoughts or special requests. All right, everybody must be feeling pretty good. All right, well, before Anne concludes, I just want to thank everyone again for coming, and I want to give a special thanks again to Bell Bank Mortgage, North Star MLS, Royal Credit Union, and Supra. I also want to mention a recording of the webinar is available on our COVID page at mplsrealtor.com. I believe we're moving to monthly, depending on what some of our surveys show. So just keep an eye on the timing for that on our website. And also, please do check out my colleague Eric's webinars. He's Mondays at 1, a great job discussing policy changes at local, state, and federal levels. And with that, I want to say have a wonderful day and come back next time.
Thank you, David, and thank you for all the hard work you do putting this together and bringing the numbers to our members.
Happy to do it. I even have fun doing it. Can you believe that? Thanks, everyone.